Howdy, Jacob here. Today we're looking at company 13, our generic stock screener, Addus Homecare Corporation in the healthcare providers and services industry. 1.6 billion market cap, a little bit higher enterprise value. It looks like they provide personal care services to the elderly, chronically ill, disabled individuals, and individuals who are at risk of hospitalization in the United States. Looking at a current P about 26% with growth that has been absolutely phenomenal with 313 million in revenue in 2014 to over a billion in 2023, with the growth year over year as low as 6.3% and as high as 25.6% over the last 10 years. You're looking at increasing operating margin from 5.8 to 8.6% and an increase in gross margin from 26.8% to 32.1%. And the only bad thing I'm seeing is return on invested capital is declining, but everything else is really looking positive here. Your balance sheet is showing 65 million cash on hand with zero debt, 124 million long-term debt. That 124 million long-term debt is, let's say, 2 years of their 5-year average free cash flow. So pretty positive signs there. They're really just making acquisitions with their income here, stock-based compensation of about 11 million. Not the biggest dent on their share issuance. So a lot of this growth is through acquisition. I really like to do a terminal P and price free cash flow based on where I think the future business is going to go. And acquisitions are kind of tough because acquisitions are historically known to really increase revenue and not so much the bottom line due to the fact that slow growth companies, dinosaur companies want to show growth. So they buy companies that are making revenue to make it look like they're growing, even though there's no internal growth. It's really just external. And so I think that for me personally, a terminal PE should be based on what the internal growth is, unless the company's historically done a great job of acquiring companies. And we're actually seeing here they have done a great job of acquiring companies by increasing gross margin, increasing operating margin through their acquisitions, which is not very common, but it's great to see that they are doing that. And I think if I were to make some assumptions here, I think 8% revenue growth a year makes sense to me. This is inclusive of reinvestment and acquisition. Their free cash flow has historically been a bit higher. Let's do a pretty big range here, maybe 6 and 8. Share change, stock-based compensation, like I said, was about 1% with 11 billion. Yeah, let's just do 1%. Terminal PE, let's do 18, 18, 15. And I mean, I think I'm pretty comfortable with this. Companies that grow through acquisitions are harder for me than companies that grow innately because the companies they acquire may not be exactly in the industry, or they might be in the industry, but not exactly ways of making money that organically that they would. But I do think I'm comfortable with this, and we're saying it needs to fall roughly in half, maybe a little bit more to get the return I'm looking for. Again, not the biggest surprise there. You're looking at 26 current P. I'm bringing it down to 18 with the revenue growth not out substantiating the discount rate. But I mean, it could be. I do think that this is a good business. I mean, they've historically done a great job of acquisitions. There are a few companies that do that, but they can do very well. And this could be one of those companies. But for me, the price point just doesn't seem stupendously obvious to me. So I will be sitting back and awaiting, looking at other companies to possibly put my money into. I do hope you enjoy the video and have a great rest of your day.